Order blocks are often presented as one of the most powerful concepts in smart money trading. On selected charts, the setup can look almost perfect. But what happens when we stop choosing only the best-looking examples? In this study, we tested more than 242,000 order block trades across 16 crypto assets and 5 different timeframes. The 5-minute results collapsed after realistic fees and slippage. The 1-hour results depended heavily on the asset, but one time frame remained profitable across every parameter combination we tested. Here is what the data actually found. First, an order block is not an order book. An order book shows live buy and sell orders on an exchange. An order block is a price zone inferred from candlestick structure. In a bullish setup, traders identify the final bearish candle before a strong upward displacement. Price closes above a previous structure high, confirming the break. The original candle becomes the zone, and traders watch for the first return. A bearish order block follows the opposite sequence. Traders identify the final bullish candle before a decisive downward move. Price closes below a previous structure low, confirming the break. The original candle becomes the zone, and traders wait for a retest. But candlestick data has a limitation. It can show where price accelerated, where structure broke, and where price reacted. It cannot prove which institution traded there, whether unfilled orders remain, or what caused the move. So instead of proving the institutional story, we ask a measurable question. Do objectively defined order blocks predict future reactions better than ordinary price zones? There is no single order block definition. Some traders mark the full candle, others use only the candle body, creating a narrower zone from the same move. A third approach uses the 50% midpoint, changing both entry and stop placement. Some methods also require a fair value gap and a liquidity sweep before the block is accepted. Others add premium or discount, a session filter, or a separate market structure shift for confirmation. Lower time frame confirmation may also be required. Every extra condition changes which setups enter the backtest. This creates a serious backtesting problem. Before the outcome is known, the setup appears valid, and the block is accepted under the chosen rules. After a loss, a flexible definition can be reinterpreted. The same setup is dismissed as not being a real order block. That hindsight bias makes the method difficult to reproduce. For this test, we use one mechanical definition. The origin candle, confirmation, first retest, and invalidation are determined before the outcome. Winners and losers follow exactly the same rules, with no future information. Therefore, the conclusion applies only to the precise order block definition tested here. For this study, a bullish order block starts with the final bearish candle before a strong move higher. Within the next 3 candles, price must travel at least 1.5 times the 14-period average true range. Price must also close above the highest high of the previous 20 bars. That close confirms the structure break. A slow drift or a wick-only break does not qualify. A bearish setup follows the opposite sequence. The origin candle is bullish, displacement is downward, and price closes below the previous 20-bar low. We use the full high to low range of the origin candle as the zone. The zone is not active when the candle first appears. It becomes valid only after displacement and the structure break are confirmed. This prevents the backtest from marking a successful zone backward in time. Every asset and time frame follows the same detection rules. After confirmation, the strategy waits for the first return to the midpoint of the zone. Only the first midpoint retest can trigger an entry. The stop is placed beyond the opposite edge of the block, plus a 0.1 ATR buffer. We test targets at 1R, 2R, and 3R. The headline results use 2R. If the stop and target are both touched inside the same candle, and lower time frame data cannot establish which occurred first, the simulation records the stop first. This is intentionally conservative. The origin candle, confirmation, entry, stop, and target are all defined before the outcome is known. These rules do not represent every possible order block method. They represent one repeatable model that can be tested without hindsight. With the trading rules fixed, The next step is to define the data and execution assumptions. The study uses Binance USD-M Futures candlestick data across 16 crypto contracts and 5 timeframes. The mature and relatively liquid group contains Bitcoin, Ethereum, Solana, BNB, XRP, Cardano, Dogecoin, Chainlink, Avalanche, and Litecoin. A second group examines 6 younger and more volatile contracts: HLAB 1000 PP, WIF, Turbo, and ACT. The 5 tested timeframes are 5 minutes, 15 minutes, 1 hour, 4 hours, and 1 day. For mature contracts, the main research window extends from January 2021 through June 2026. Newer contracts begin only when reliable historical data becomes available. They are not treated as though they have the same history as Bitcoin or Ethereum. The execution model includes a fee of 0.05% per side and slippage of 0.05% per side. Total assumed cost is therefore 0.1% on entry and 0.1% on exit, or about 0.2% for a complete round trip. Funding payments are not included. The data is separated chronologically into development, validation, and locked out of sample periods. Missing data gaps are also respected, so trades cannot pass through unavailable candles as though the execution sequence were known. Before measuring profitability, we first ask a simpler question. Do order blocks produce stronger future reactions than ordinary price zones? This first comparison does not place trades. It measures how far price moves after returning to 3 different types of zones. Order blocks produce a 0.5 ATR reaction in about 65.7% of cases. Random candle zones reach the same distance in about 56%. At 1 ATR, order blocks react in about 48.4% of cases, compared with 37.8% for random zones. This suggests that the mechanical order block rule contains more information than choosing an ordinary candle area at random. But the comparison with traditional swing support and resistance is much closer. Swing zones produce a 0.5 ATR reaction in about 69.2% of cases. At 1 ATR, the swing result is 48%, almost identical to order blocks. At 2 ATR, swing support and resistance reaches the threshold in about 26.1% of cases, compared with 22.3% for order blocks. The evidence therefore supports a limited conclusion. Objectively defined, order blocks react better than random candle zones, but they are not clearly superior to conventional swing support and resistance. The concept may still be useful, but the data does not support treating it as a uniquely powerful reaction area. More importantly, a visible price reaction does not automatically create a profitable trading strategy. Price may move away from the zone but fail to reach the target. The stop may be too wide relative to the available movement. Fees and slippage may also consume most of the gross advantage. Under the base 2R execution rules, the expanded study generates 242,020 trades. The combined profit factor is only 0.311. Average expectancy is approximately negative 0.942 R per trade. The locked out of sample segment is even weaker with a profit factor of approximately 0.269. This does not mean every time frame behaves equally badly. The combined result is heavily influenced by the very large number of 5-minute trades. Higher time frames produce fewer signals and can show a very different pattern. The key lesson is that reaction frequency alone is not enough. A useful method must produce movement that is large enough, consistent enough, and inexpensive enough to survive the entry rule, stop distance, target, fees, and slippage. The next step is to separate the results by time frame and cost. The 5-minute time frame produces the largest number of signals, so it is a useful stress test. Before trading costs, the pattern looks profitable in both market groups. The mature and liquid cohort reaches a profit factor of about 1.609. The young, high volatility cohort reaches about 1.662. Both results sit clearly above the break-even level of 1.0. At first glance, that looks like a broad edge. But these are gross results. They assume entering and exiting the market is free. On 5-minute charts, zones are narrow and trades close quickly, so even a small percentage cost can consume a large share of the risk on each position. Once the base fee and slippage model is applied, the picture changes completely. The mature cohort falls to a profit factor of only 0.191. The young cohort falls to 0.517. Every one of the 16 tested assets remains below break-even on 5 minutes after costs. This is not a small reduction. It is a collapse of the gross edge. The zones may still identify real short-term reactions, but those reactions are too small relative to stop distance and execution cost. The result shows why cost-free backtests are dangerous. A pattern can look profitable in raw candles and still be unusable in practice. Under this definition and execution model, 5-minute order blocks should be rejected rather than optimized further. Moving above 5 minutes reduces the relative impact of fees and slippage, but it does not create a universal edge. On 15 minutes, the mature and liquid cohort remains weak or mixed. Some younger contracts perform better, but the outcome depends heavily on the individual asset. The 1-hour time frame shows the same pattern. A few coin and direction combinations are profitable while many others remain below break-even. A single average can hide both groups. This distinction matters. A method can appear convincing when only the best-performing symbols are shown after the test. That is not the same as demonstrating that order blocks work broadly. The evidence must separate a general rule from an asset-specific opportunity, and it must also preserve the losing symbols rather than removing them after inspection. In this study, 15-minute and 1-hour order blocks are better described as research areas with profitable pockets. Those pockets may be useful, but they should not be treated as proof of a cross-market edge. The result also explains why traders can report very different experiences with the same concept. One trader may focus on a coin and period where the rules work. Another may trade a different asset where the same rules fail. Both experiences can be genuine, but neither proves universality. The correct next step is to identify which symbols, directions, and time frames remain positive across chronological segments. Then test those streams separately. Among the 5 tested time frames, 4 hours produces the strongest overall research result. 5 minutes is rejected because realistic costs dominate the small price movement. 15 minutes and 1 hour remain mixed and asset dependent. Daily results can look attractive, but many assets produce too few trades for a strong conclusion. 4 hours occupies a more useful middle ground. The zones are wider, price has more time to move, and the same percentage fee represents a smaller share of total risk. At the same time, the dataset still contains enough trades to compare assets and nearby parameter settings. This balance matters because a high profit factor from only a handful of daily trades is less informative than a moderate result supported by a broader sample. The strongest evidence is not simply that one 4-hour configuration makes money. The important result is that nearby configurations also remain above break-even. A fragile backtest often contains one isolated best setting. If the structure lookback changes slightly or the displacement requirement moves by half, an ATR, performance disappears. That usually suggests optimization around historical noise. The 4-hour result behaves differently. Performance remains positive across several structure lookbacks and displacement thresholds. This does not make the strategy ready for live deployment, but it makes 4 hours the most credible direction for further research. The conclusion is selective. Do not assume all order blocks work, and do not assume the most active time frame is best. Under these exact rules, 4 hours deserves the most attention because it balances execution cost, sample size, and parameter stability better than the alternatives. To test whether the 4-hour result depends on one optimized setting, the study changes 2 important rules. The structure lookback is tested at 10, 20, and 30 bars. The displacement threshold is tested at 1.0, 1.5, and 2.0 ATR. Together, these choices create 9 nearby parameter combinations. Every combination finishes above a profit factor of 1. The lowest value is approximately 1.204. The highest is approximately 1.359. The strongest cell uses a 30-bar lookback with a 1 ATR displacement threshold, but the conclusion does not rely on that single cell. the full neighborhood remains positive. This is more useful than finding one maximum value. It suggests that the result is connected to the broader market structure being tested, rather than to one precise historical setting. There is still variation. Stricter displacement requirements usually produce fewer trades, and profit factor changes across the matrix. Stability does not mean every setting is equally good. It means small changes do not immediately destroy the result. That reduces, but does not eliminate, the risk of curve fitting. The matrix does not prove future profitability, but it makes the 4-hour result more credible than lower time frame results that are weak, cost-sensitive, or dependent on a narrow group of assets. Asset-level results show why broad averages must be interpreted carefully. Lay-B on the 15-minute time frame is one of the more interesting young contract examples. Its development, validation, and relative locked out of sample segments all remain above a profit factor of 1. The values are approximately 1.198, 1.146, and 1.264. H on 4.6 and 1.264. H on the 1-hour time frame shows a similar pattern. Development produces a profit factor of about 1.126, validation is approximately 1.075, and relative locked out of sample is approximately 1.213. These values are positive, but the contract has a short history. The final two segments contain only 34 and 38 trades. WIF on 4 hours produces even stronger numbers. Development is approximately 1.611. Validation is 1.301, and relative locked out of sample is 2.196, but the segment sizes are only 73, 24, and 26 trades. A high profit factor from 26 trades can be encouraging, but it is not strong evidence by itself. 1 or 2 unusual trades can materially change the result. The fact that all 3 chronological segments are positive is useful, yet the uncertainty around the estimate remains large. This is why the study separates mature contracts from young, high-volatility assets. Short history contracts can reveal possible behavior, but they cannot provide the same level of evidence as several years of data. These streams are promising candidates for continued observation, not finished trading systems. More future trades are required before the apparent edge can be trusted with meaningful capital. The base strategy trades every mechanically valid order block. Across 242,020 trades, that broad test produces a profit factor of approximately 0.311. Aligning trades with the higher time frame direction improves the market logic, but it does not solve the profitability problem. Profit factor remains only about 0.367. 2 filtered cases look more interesting. A practical combination based on trading, cost, and zone width reduces the sample to 17,257 trades and raises profit factor to approximately 1.280. A stricter case using higher time frame alignment, a trending condition, and stronger displacement reduces the sample to 4,640 trades and produces a profit factor of approximately 1.391. These results suggest that the base concept may contain useful information when the worst conditions are removed, but filtered results must be handled carefully. Every additional rule creates another opportunity to fit the past. A profitable filtered table is not enough unless the filter was defined before the final test and remains positive in separate chronological data. The reduction from hundreds of thousands of trades to only a few thousand also increases uncertainty. The broad locked out of sample segment contains 57,382 trades. Its profit factor is only 0.269, with expectancy near negative 1.054 R per trade. The filtered cases should therefore be treated as research leads, not final proof. They need their own predefined locked out of sample test, followed by forward observation under the same unchanged rules. This study has several important limitations. First, candlestick data cannot prove institutional intent. It can identify acceleration, structure breaks, zones, and reactions, but it cannot identify who traded, whether unfilled orders remain, or what caused the move. Second, the research tests one mechanical order block definition. Different definitions, entries, stops, targets, or confirmation filters may produce different results. Third, funding payments are excluded. This matters more for trades that remain open across funding timestamps. Fourth, young contracts have limited histories. Some promising daily and 4-hour results contain very small samples, so their profit factors can change sharply after only a few additional trades. Fifth, OHLCV candles do not always reveal the exact intrabar sequence. When a stop and target are both inside one candle and smaller timeframe data cannot resolve the order, the test records the stop first. Finally, historical simulation cannot guarantee future performance. Market behavior, liquidity, spreads, and participant structure can change. Data quality and exchange conditions can also differ from the assumptions used here. These limitations do not make the research useless. They define what the conclusion is allowed to say. The study evaluates whether one reproducible order block rule produces measurable reaction and trading performance under stated assumptions. It does not prove an institutional story, and it does not evaluate every method that uses the order block name. So, do order blocks actually work? The answer depends on what work means. If work means that price reacts more often than it does at a random candle zone, the answer is yes. Mechanically defined zones contain measurable information. If work means that order blocks are uniquely superior to swing support and resistance, the answer is no. The swing baseline performs similarly. If work means every order block should be traded on every asset and time frame, the answer is clearly no. The broad strategy loses heavily and the 5-minute edge disappears after realistic costs. If work means selected versions may be useful in selected conditions, the answer is maybe. 4 hours is the strongest research candidate. All 9 nearby parameter combinations remain above break-even. Some young contract streams also look promising, although their samples are limited. The defensible conclusion is that order blocks are a testable market structure concept whose value depends on definition, time frame, asset, execution cost, filters, and validation. A practical workflow begins by defining the zone mechanically. The origin candle, confirmation, entry, stop, target, and invalidation rules should be fixed before the outcome is known. Higher time frames should be tested before, assuming that more signals are better. Every backtest should include realistic fees and slippage. Assets and market regimes should be evaluated separately. A profitable stream on one young altcoin does not automatically transfer to Bitcoin or Ethereum. Development, validation, and locked out of sample periods should tell a consistent story. Promising short history streams should remain under observation until more evidence accumulates. The final lesson is simple. Use order blocks as context, not as automatic proof of a trade. Let reproducible rules identify the setup. Let cost-aware, out-of-sample data decide whether the setup deserves capital. That approach is less exciting than a perfect chart example, but far more useful for judging whether a trading method has a real edge. If you found this analysis useful, subscribe to Market Method Lab. And if there is a trading method, indicator, or setup you want tested, leave it in the comments below. I will build a transparent cost-aware backtest, show where the method works, where it fails, and whether there's any real edge worth researching further. Your request could become the next video.